let's use the time value of money and do some bond calculations with it, which is something that you would really use time value of money for in business world. And you use it for a lot of things, but this is one you see frequently done. So let's assume that our company is going to issue some bonds. We're going to do some debt financing. So let's put down some information. Let's say that on, say, June 30th of this year, 2014, we issue $500,000. Let's do $500,000 of bonds. Let's say that they're 10% bonds, and that they're going to mature in 10 years. Interest is paid semi-annually. And let's say that it's paid on June 30th and December 31st. And then let's also put down here that market rate of interest is 8%. Okay, so I've got a lot of scribble up here. But let's decipher it. Let's go back. So on June the 30th, 2014, we issue $500,000 of 10% bonds that mature in 10 years. Interest is paid semi-annually on June 30th and December 31st. And the market rate of interest is 8%. Excuse me, sorry guys. So I need to know how much I'm going to issue the bonds for. Okay, $500,000 is what we refer to as the face of the bonds. We will have to pay back $500,000 to the bondholders. So whoever buys the bonds, when they mature in 10 years, and they're due, unless they get called early or there's some other provision in the bond, we will pay back the $500,000. Okay? This amount here, this 10%, is called the stated rate of interest. Right? We need to know this to figure out how much interest we're going to pay the bondholders over the term of the bonds. Okay? The term is 10 years, so in 10 years, they're going to be due. We're going to pay them back, but over that 10-year period, we're going to pay interest semi-annually. So every 6 months, we're going to pay out our interest payments. And again, that's what we need to know this 10% for, is to calculate how much interest we're going to pay our bondholders. Then we also need to know this market rate of interest. Market rate is 8%. Okay, that's going to help us know something about the issue price. So, I'll give you a couple scenarios without us running actual numbers. Okay, think about this. You're in a bond market, okay? And let's say that I'm offering bonds, and I say, hey, come buy my bond. I'm going to pay you 8% interest on it. Okay, and then you have a bond, and you're offering, and you're telling everybody, hey, come buy my bonds. I'm going to pay you 10% interest. And let's say the face amount of the bonds are the same thing. So you could buy a $1,000 bond with them. You can buy a $1,000 bond with me. I'm going to pay 8% interest. You're going to pay 10% interest. Whose bond would you prefer to buy? Hopefully you're going to say yours, because you're paying a higher rate of interest than I am. Okay? So if the bond market, if it's got about an 8% effective rate of interest, and you're going to offer yours at 10%, then you're going to get what's called a premium. If the stated rate is above the market rate, okay, your bonds are more attractive, so you can charge a higher price, or you'll get a higher price for them for the effective rate. Okay, so when we do a calculation for this, you should expect to see a number higher than 500,000. We won't say what it is, but in general, you should know by looking at this, your answer should be more than 500,000. Now, it shouldn't be, 2 or 3 times that, but it should be something larger than $500,000. If this had said 15%, the market rate was 15%, that means that everybody in the marketplace, not everybody, but the effective rate is 15%. You're offering it at 10. Yours aren't looking too attractive, so yours are going to get issued at a discount. So you should expect your calculation to give you something less than $500,000 when you figure out the issue price. Now, if this said 10%, there's no difference between stated rate and effective rate. Then you will issue them at face. So you'll get exactly $500,000 if that's the case. Okay? So there's some things to know about bond. When you issue the bond, and I want to know the issue price, then we have to consider time value of money. Okay? And we have to consider two things when you look at issue price. You need to know, well, first let's talk about, all right, the $500,000. I told you we're going to have to pay that to the bondholders. When am I going to have to pay them? Am I going to pay them $500,000 today? I hope not. That would kind of negate the whole need for the debt financing. Okay, we need money right now. We're going to say we're going to pay you later, okay, after we've made some more money. So you're going to give me money now, and I'm going to give you money later. I'm going to pay this $500,000 back in 10 years. So $500,000 is what value? Is it a present value or is it a future value? The $500,000 is a future value. I know I will pay $500,000 in the future, but what I want to know right now is, okay, because of that, what is the value of that to me today? So I need to figure out the present value of the face amount. That's one thing I need to figure out, okay? Is any other payment involved here? We will pay the $500,000 back. But what else am I going to pay associated with this bond? I'm going to pay interest. So I also need to know the present value of the interest payments. Okay, so there's two things we need to know to figure out how much we're going to get for the issuance of the bonds. Okay, present value of the face, present value of the interest payments. So let's talk about the face. All right, present value of the face, we know that the face amount is $500,000. Is this a lump sum? Is it a single sum? Or is it an annuity? If it is a lump sum, then it's just one time. If it's an annuity, it's multiple times. Okay? And it's equal amounts, equal time. This one is just one time in 10 years, this $500,000 is going to get paid. So this is a single sum or a lump sum. So we need to go get a factor for this. So we need to go look in the tables, present value of 1 or present value of $1, okay, and get a factor to multiply this by. What are we going to look for as far as interest and the time frame? Okay, well, be careful. You've got two interest rates here. How do I know which one to choose? Well, what did we say this one was important for? We said the 10% tells us what? It tells us how much interest we are really going to pay. But it didn't tell us anything about the difference in the issue price. I mean, it did. We compared it, but we compared it to the market rate, the effective rate. So this is the amount we want to use to find our factor in our tables. So you want to go and look at the present value table, and you're going to base it off of the 8%. But again, be careful one more time. How often do we pay interest? We pay it semi-annually. So how many times a year are we paying this? Twice. So what happens to this interest rate? It needs to go to 4% because this is a per annum. We're not doing this once a year, we're doing it twice a year. So in your table here, you need to be looking up 4%. This is in the present value of 1. You need to be looking up 4% at how many periods? Well, the bonds are 10-year, but again, you're doing this twice a year, so you need to look at 20 periods. Okay, so when you go and do that, you should find a factor of 0.45639. So my total here is going to be $228,195. That's the present value, that $500,000 of the face amount. But again, there's something else involved. We also pay interest. Okay, so the first thing I need to know is how much are my interest payments? How much are my interest payments? Well, how do we calculate interest? All right, remember our good old principal times rate times time. What's the principal on this? What's the face of the bonds? They're $500,000. What's the rate? Well, you really can put 10% if you want to here. Because what's the time? It's semi-annually, so it's 6/12. Or you can shortcut this and do 500,000 times 5%. It doesn't matter. You're going to get the same number either way you do it. Every 6 months, you're going to pay $25,000. Now let me block these off. That's a present value calculation. I don't want us to get confused. Okay, So now, the $25,000 is what I need to use as my annuity figure because every 6 months I'm paying $25,000. So this is what I need to multiply my factor by. So when are these getting paid? Okay, we know this is an annuity, but what kind of an annuity? Is it an ordinary annuity or is it an annuity due? We issued the bonds on June the 30th, and that would have been when the first interest payment was made. But can any interest really calculate if it's at the same time? No, so we have to wait till the next one. So this looks like an ordinary annuity. It's at the ends. So yeah, so this should be, you're going to flip back to your present value of an ordinary annuity table, and you need to find the factor. Remember though, this is semi-annual interest payments. So it's not 8%. You do use the market rate of interest. Do not use stated interest in the factor tables. Okay? Do not use stated interest in the factor tables when we do these bond calculations. So the 8%, but it's semi-annual, so we use 4%, just like before, and that's for 20 periods. We're going to do that 20 times, semi-annually. Okay? You should find a factor of 13.5903. So that gives me $339,832.50 if we don't want to cut this off. So that is the present value of the interest payments. We're going to take this and this, we're going to add them together. If we add those two together, you will get $568,027.50. This is the issue price of the bonds. And as we said before, if market was 8 and our stated was 10, we should have issued these at a premium, did we? Yes, we issued it at a price above the face. This is a premium. And our premium is the amount over face. So the premium here equals $68,027.50. Okay? Now something else to consider. Let me pause there and let you look at this before I erase and go on. Something else to consider here. If this would have been higher, as we said, it would have been a discount. So you would have gone through the same calculation, but your ending answer should have been less than the face amount. But when you have bonds and they're issued at a premium or a discount, you're going to have to amortize that premium or discount over the term of the bonds. Because the whole point is at the end of the maturity period, so for us in this example, at the end of 10 years, we would have amortized this back to the face. That's the point. So for bonds, if you have a discount, okay, let me get a new screen. For bonds, you have something called carrying value. And carrying value is equal to the face minus the discount, or face plus the premium, depending on which situation you have. Okay? So for us, the carrying value we just saw, the face was $500,000. We had a premium that adds to, the premium was $68,027.50. So our carrying value was the $568,027.50 when we issue them. Okay? Issue price will be carrying value the first time. It will change, however, over time. Now, the whole point is we have this at a premium. Over the next 10 years, we are going to, oh, bad arrow, we are going to amortize this, and at the end of the 10 years, this should equal $500,000. Okay, through amortizing it, we should get back to the face value, because at the end of 10 years, this is all I owe the bondholders. Okay, if we, I mean, you can have gains and losses on bonds. Again, we won't get into that detail right now, but if you fully mature, you fully amortize the discount or the premium, then you'll get back to your face amount. Okay? So let's look at how we would amortize this. We have a premium. Okay? When you issue the bonds, you'll get cash, let's do a journal entry, of $568,027.50. You will have bonds payable for the face You record this at face value, which I'm not going to put it all the way over there since I'm going to run into this. And then you had premium on, and I'm going to shortcut this, bonds payable. And that was our 68,027.50. Okay? So the premium matches up with it because it adds to. If it was a discount, it would have been a debit because it deducts from. Okay? So over time, we need to take this 68 and it needs to go away. We need to reduce it each year. If it was a discount, we would reduce it also, but it would actually make the carrying value go up because it would already be below the face because it's a discount. So we can use something called the effective interest method of amortization to amortize the discounted premium. You could also use a straight line amortization, which is where you take this and you simply divide it by the term of the bonds. So if we were doing straight line, you would take 68,027.50, and most companies, I would say, do this each time that they pay the interest. So you would actually divide this by, what was our term, 10 years? Yes, so you'd divide this by 20. What is that? I didn't have that calculation. Hang on. You could do this annually. If you did it annually, you would simply divide it by 10. But companies usually are going to do this when they make their interest payments. So this would be done with the interest payment semi-annually. So this would be 3401, about 38 if I round. Each 6 months. That's how much we would amortize. But you can use the effective interest rate method as well. Okay, I'm going to delete this. Regular, if not, pause for a minute because I'm about to. Okay. With that, I'll make up kind of a little table. This is effective interest method to amortize your bond or premium. I mean your premium or discount on bonds. Right? So for our example, we had issued these on June the 30th. Alright, so way over here I'm going to put, here, let me go ahead and make sure I have enough room. We're going to have cash paid, we're going to have interest expense, we're going to have amortization, and then we're going to have carrying value. Okay, so on the issue date, the carrying value is the amount that you got for the bond. So I'm going to put our 568,027.50 right here. Okay, and beware this slant. I'm going to try to keep it even, but I can't make any promises. So the next time, when's our next interest payment? Okay, 630 would have been it, but there's no interest to do, so you know, can't really do that. So the next one would have been on 12/31, and we would have paid how much? How much were our interest payments? Remember? $25,000. So we really will pay $25,000. All right. To calculate interest expense, what we need to do is we need to take the carrying value and multiply that by the effective interest. For us, that was our 8%, or rather 4% every 6 months. Okay, so we're using the 4% here. Here we're using the 5%. Okay, so just to kind of keep that in mind as we go forward. Okay, so this one is going to be, again, you take carrying value, previous carrying value, multiply it by your effective interest rate, and it was 8%, but we're doing this semi-annually, so you have to do that in half. So this is going to give me 22,721.10. Okay, amortization is the difference between these two, so you just take the difference. So we're going to amortize off $22,78.90 worth of the premium. When we do that, it changes the carrying value. It's going to decrease it. With premiums, you're always pushing it down towards the face. With a discount, this would be below the face, so it would increase. We'd push it back up. So this now would be $565,748.60. Okay, let's do just a few more. I'm not going to do all the way to the end, but if we did this to the end of the bond term, you'd find that the carrying value gets to $500,000. All right. Next one's going to be 630.15. Again, we're going to pay $25,000 as we do each 6 months. We're going to take this new carrying value, multiply it by the 4%, okay? And that's going to give me 22,629.94. We take the difference to find out how much to amortize of the premium, and that's 2370.06. Again, carrying value is getting lower, so the interest expense is going to go down as well, and we amortize more each time off the premium. So now my carrying value is 563, 378.54. Let's do one more. 1231.15. Again, still paying $25,000. That's not going to change. New carrying value here. Multiply that by the 4%, and that gives us 22,535.14. The difference, 2464.86. And now take that away, and we get 569.13.68. New carrying value. Okay, again, we're always getting closer to the 500,000 face. Let me show you what a journal entry would look like. Let's do this last one. So our interest expense is going to be debited for 22,535.14. And depending on whether you have a premium or a discount will differ as to whether this amount's debited or credited. Think about it. A premium, it's an amount over the face, and it increases and matches up with the bond. A bond payable is a liability. If it acts in the same manner, then it would hold a credit balance. The whole point of amortization is to make that go away. So we want to decrease it. How would we decrease a premium? We would debit it. The same logic goes through, I'm going to shortcut bonds payable, but that's what this means. The same logic would go for a discount. Discounts are the opposite of the bond account. It deducts from it, okay? So it has a normal balance of a debit. We still want to decrease that, but how do we decrease that one? We would credit it, okay? So the premium here was $2464.86. That's how much we amortized, decreased it by. And then we paid $25,000 in cash. There we go.